Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Thursday, March 28th, 2024. Most notable data coming out this week is tomorrow on Friday, the PCE data coming out. However, markets are closed on Friday, and so it'll be extra interesting to see what happens when market participants have all that extra time over the weekend to digest what's going on with PCE. Since practically speaking, we're at the end of the week, might as well take a look at least one weekly chart. This is the S&P 500. From a weekly perspective, this doesn't look like it is turning over or even going sideways. We have, as far as weeks go, we have a closing new high on the S&P 500. Now it looks a little different on the daily charts, and I wanted to bring up a few interesting things going on regarding that. Firstly, I want to point out this wedge pattern that Gareth Soloway on his show, Verified Investing, pointed out and had mentioned how we have not had a confirming breakdown of this trend line in the S&P 500. We saw it in the NASDAQ, but not here. And recently we have confirmed he's bearish on this as far as a daily perspective goes, and so that gives me, on top of the fact that, again, I'm going to repeat this ad infinitum because it still holds true, and I think it's massively important. The Fed has been strangling the economy. The economy has been slowing down. Inflation has been going down. The markets, the stock market, went way up. I mean, so much though, so that the current earnings make the S&P 500 as a whole overvalued as it is. And if earnings contract, then it just makes the current price even that much more overvalued. Can the S&P 500 go up from here? I guess it can, but if I'm an investor, I'm not going to be participating in this. I'm not going to be buying it, and I'm not going to be holding it. I'll wait until the markets start making some kind of sense, and they're not making sense to me. And so I'm actually, in this video, I'm going to show towards the end my current entire portfolio holdings in terms of percentages. And as you'll see, I do not trust stocks as a whole right now. Now, I think one very, very, very important thing to pay attention to is what's going on with the RSI, Relative Strength Index. This is how confident are people in the current price movements, basically. And there's a major divergence here. When you talk to a lot of professional traders, they will show you the same thing. Basically, when you have RSI showing lower highs, a pattern of lower highs, let me pull this up, sorry with the problems with the charting. See this line here, and we keep bumping our head on it over and over again, and it's going down at the same time the S&P 500 is going up. This is not normal. This is not healthy. This is not a bull market that you can depend on. In fact, this is one of the really big alarm bells going off for professional traders right now. When you see a RSI showing lower highs, lower highs, lower highs as something, any stock market chart, and especially with the S&P 500, these are alarm bells going off here. I'm seeing a big correction coming soon here, and still in the NASDAQ as well, the Qs, QQQ. Now, I had been, for previous shows, talking about how high yield corporate, this is like higher risk bonds. So, you know, this is valued that when this goes up, it means that investors aren't worried too much about bankruptcy risk because they're willing to pay more for a slightly lower yield. Basically, as the chart goes up, the yield goes down. Now I just wanted to point out a similar divergence here. We have a higher high on the HYT, and from the same exact point, sorry, I'm having a little bit trouble with these charts, from this same exact point, as you can see, RSI, when we made a new high in HYT, we did not make a new high in the relative strength index. This is, again, alarm bells going off. Today on the daily, we saw a little bit of weakness. Again, there's not a lot of fear here overall, but this is just another one of those signs that, like, you know, when I look through my crystal ball at the chart, I can see fairly clearly that this is a top. This is a top in the S&P 500, a top in the Qs. I've been talking about this, and I think this is it. I think we've pierced the bubble, and we're going to see some pain ahead. Last very notable chart for me, the Treasury bonds. This is TLT. I'm noticing that we are seeing, you know, I've been talking about this looking like a head and shoulders here, and today we hit the line again. And so it'll be very interesting if we break through this neckline, if we can have, you know, from head to neck play out from head to neck here, sending TLT around to the $100 area with pretty high probability from this pattern playing out. And it would make sense with markets collapsing. You know, when money gets really scared, it runs to safety. Treasury bonds are safety. Treasury bonds can't go bankrupt. It's a guaranteed return on your dollars, and dollars are the world reserve currency. And so it's, you know, it's massively important to at least be paying attention to this. Again, like I've said in previous shows, I have 40% of my own portfolio in a fund called ZROZ. It's long duration treasury bonds. I'll be sharing that along with my other holdings at the end of the video. I first wanted to talk about silver. Now, I had been excited about silver, you know, especially considering how it's been sort of suppressed in price comparatively to gold, and how, you know, it has a dual usage. It has the ability to be used in electronics, solar panels, all sorts of industrial uses. I believe they even use it for farming. They actually turn it into a liquid of some kind to put in clouds to help make it rain, I think, if I remember correctly. So they're spraying silver into the air. You know, it's used that way, but it still has, you know, precious metal value as well. Although it's been very unpopular. Silver has been arguably suppressed for a long time, or has it? And so that's what I wanted to bring up. And so SILJ, I had previously had about 10% of my portfolio in this. I had bought around this low point that we kept bumping on. I'm like, well, why not? You know, this is good support here. The markets aren't, you know, back here when I was buying it, markets weren't as terribly overvalued. And so I was comfortable to buy it and be like, oh, maybe things will normalize. And we hit this trend line here, and I sold all of it. I'm currently completely out of silver, mostly because of the fact that I think if there is a major stock market correction, I don't think it's going to allow very many things to be fine. I think when people sell things, they tend to sell everything at the same time. I don't think silver is going to be the safe haven that it could be. You know, gold and treasury bonds are like the kings of running to safety. But even gold, when everyone's selling everything, can have a downturn. You know, that's one argument that I have against Gareth Soloway's positioning. I do not believe gold is a safe haven in a market crash. It's a safe haven against runaway inflation, but we don't have runaway inflation. Not right now. If anything, the fear that's coming when I see into my crystal ball is disinflation, deflation, and gold will not perform well in that kind of environment. So adding to the reason why I sold 10% of my portfolio today to get out of silver has to do with price. Where are we on price? It's $24.56 an ounce according to this chart. This is macrotrends.net. When we zoom out, we have this chart of showing the history of silver prices. Now I took the liberty of taking this chart. It starts in 1915 from Macro Trends. Copy pasted it into Paint so we could see a few things a little more clearly. So inflation adjusted is checked off in this view of the chart, and I just wanted to point something out. You know, I had been as excited about silver as all of the other silver bugs out there, thinking like, oh, it's time again. It's time for a super cycle in silver. But you know, a lot of these investors, pretty much everybody that's involved in investing lived through the squeeze in 2011, and many investors also, you know, in the, I think it's the early 80s when silver, there's a whole history to it. There was like some rich investors that were buying up all of the silver, and they made a humongous spike in it. Like I think the late 70s, early 80s. But anyways, just because silver has had gigantic spikes in the past, you know, this spike going all the way up to $140 an ounce, and then in 2011 going to around, it looks like $70 an ounce. You know, if you look back to 1915, this is not normal, you know. In fact, I would argue that the normal range looks to stay between these two bars. Now, mind you, this chart is inflation adjusted, and so we're talking about what is the price, you know, how many pieces of bread can I get for an ounce of silver. That's what this represents. And you know, it goes above $20 sometimes, occasionally. You know, in recent history it seems to hang out there a little bit longer, but it seems like it's, you know, you look back in time, its most comfortable range is very obviously below the $20 range. And if it's $25 right now, is this something cheap? Is silver cheap right now? No. Silver is not, from a historical, as much as we want silver to have another one of these massive squeezes, it's a very speculative position, in my humble opinion, to believe that we will see necessarily another spike in silver. And in fact, I think there is a greater risk here for it to drop back down into the sub $20 range. You know, it seems like, I mean, even if we draw a line halfway between $20 and zero, it seems like, okay, it might be cheap at around $10 in today's dollars, or lower than $10. But do we want to have silver exposure when it's at $25, $26? I'll wait. Last chart of the day is my own chart. This is my own portfolio of holdings. And as I said before, recently my precious metals was around 10%, or rather 12%. The current 1.3% is actually REMX, which is more exposed to platinum and palladium, which is still, in my opinion, undervalued when I take a look at history and what's going on. Now, I'm not so excited that I have more than that in that right now, but that's that position. But I'm 40.5% in 0Z. I have almost 28% cash, a little bit in ARC in areas I think that are undervalued, like the PRNT and the ARC G, I think, are still have room to grow. You know, some of the holdings actually in ARC G, I noticed, have low PE ratios, and they've been around forever and make money. I mean, you know, that's fine with me. I mean, it's not like unbelievably cheap, but cheap enough to be, you know, I'm okay with it. And then China, undervalued in general. This gambling slash hedge portion, 7.3%. 5% of this is the short, the SQQQ. A small portion of that, 0.3% of the whole portfolio is actually SOXS, the shorting semiconductors. But 5% shorting, the other 2.3% is actually in leveraged Brazilian equities, which I think Brazil, you know, based on chart patterns and crystal ball readings and all sorts of things, I'm very excited about Brazil, and you know, it's so undervalued that I'm just gonna hold on to it, even if it drops from here. I mean, I'm holding it. You know, if we see a market collapse, I mean, the cool thing about international exposure is that there is a little bit of sort of a firewall between the U.S. equities market and worldwide equity markets. You know, especially considering the PE ratios of all the companies in Brazil right now. You know, even if we saw some sort of normalization where the S&P 500 came down to more normal level and Brazil went up to a little bit more normal level, I can see that happening. And so I have leverage on top of my regular Brazil equity portion of my portfolio. So anyway, I just wanted to share that with my watchers. And that's all I have for you today. I hope you enjoyed the show. Thank you very much for watching. Robschild.